In the months of August, September, and October, markets tend to be incredibly volatile in the US. We all know this, but this year is like no other. A US election on top of it that's expected to be hotly contested, and a bubble that's appearing in several stocks. So what happens next for the S&P 500 and NASDAQ? In today's video, we break it down together, including what's going on in the options world and the massive dark pool transaction trades that we've started to see appear. What are those sneaky Wall Street traders up to? Today, we take a look at the opportunities throughout the stock, commodity, and crypto markets together. Join us, guys. This will be a great one. Well, welcome back everyone to the Daily Show. My name's Tom, and as always, we'll be going through everything to do with the macro, the data, and what we need to know right now about market conditions. If it's your first time here, then why not subscribe and smash that bell icon if you love markets like we do, and you want to know a little bit more about options, dark pool liquidity, and of course, where the biggest flows are going on a daily basis. So this week is no doubt incredibly important. Non-farm payrolls, FOMC rate decisions, overall press conferences, and of course, big earnings season with Microsoft, Apple, Meta, and many others coming out in less than just a few days to give us their announcements. But will they be good or bad? Well, this earnings season so far has been kicking off pretty well, with over 80% of stocks actually performing better than expected to an average beat rate of 5.6%. Now, I posted this over on our X, following the links in the description down below, but this will be the big hotly contested idea. Are the S&P 500, 1500, 2000 stocks, the back end of the market, doing well enough to keep this thing abroad? Or are we going to see a real weakness in big tech this earnings season, which brings us down? Well, let's take a look at the data to do with election years. Now, this is actually when stocks tend to do when we have a president that is not running for re-election. Now, you may have seen another chart that we'll bring up in a second, which is called the lame duck chart. But basically, when we go through some of the data points here, such as Carson has done over on X, you'll notice that there could be a continued strength into the back end of the year. Particularly September and October can bring extra volatility. And then actually, in these types of years, we tend to see a sell-off after the election into a buy for the end of the year. Basically, the Christmas rally starts to come through. Now, this is what happens when we have lame duck years. And I would say, and most people out there are saying right now, that we don't have this particular event. So when we have lame duck years, it looks completely different. And that's, of course, where we get this huge divergence. Sometimes we get massive weakness in the back end of July, a little bit of strength into August, and then this huge weakness coming into the election itself. Obviously, what this is telling us is that if we start to see significant weakness throughout September, and it starts to diverge a lot with the general expectations during election year, that's when you can start to say, okay, well, we've got to follow this chart more, and therefore start to forward project it from this point also into 2025. We will be doing that on the channel here if it does come through to it. So summer rallies. We know that June tends to be pretty good. July, the first half, remember, is the best 2-week stretch of the year every year. So make sure to put that in your diary so you're aware. If technical analysis, which is always number one, is coming along with strength, then you should really be looking at strength during that period. And August tends to be pretty good, followed by September and October being a weaker period. What's for sure is volatility is going to start spiking into these events. But I want to talk about some of the data that has been suggesting that maybe we will have a rally at these points. And one of those is how fast this market actually sold off. Now, we talked about this in our weekend video. Basically, the market went from 5% above the 50-day moving average to all the way underneath it in 6 trading sessions. Now, when that happens, we actually do have some data points from that particular event. And what it tends to lead into is a pretty strong 6-month lead. In fact, 6 months later, 100% of the time when we've seen these types of reads, markets are bullish, and they're bullish in a fairly positive way. Now, I find it interesting that 2 months later, they're only bullish 50% of the time. Now, what that's telling us is that if we think about it, right now we're getting the read in July, that's kind of pointing to that September period possibly being that secondary weakness, which makes sense with a lot of the other data that we're starting to put together. So you can see how we're building a storyline that's starting to go on here. And there's more to this storyline as well. Here's another one from Jason Gotford over on X that basically says that when the Q's RSI drops below 34 during long-term uptrends, which are above the 200-day moving average, again, many reads here, in fact, a very good data set, we tend to see some strength into a little bit of questionable stuff. Guess when? 2 months later. So volatility is here. It is going to be set to stay for the rest of the year. And we know that sentiment is going to drive this a lot. Now, here's the latest read over from Mike Zaccardi over on X that says Goldman Sachs Twitter sentiment survey just pretty much topped off. Now, we saw this also top off back in 2021 during, of course, the GameStop runs and the hyperstock runs. Now, if anyone remembers that, that's when we had Zoom, Roku, and many, many others start to go ballistic, totally disconnect from reality. And it became cool to make no money as long as you had some kind of growth in your market cap. Now, that's the funny thing about this. Now we all want to see real profits, and that's why the megas have done so well. But at the same time, only a few years ago, we were in a bubble of literal companies that were making no money, trading at hundreds and hundreds of X multiples, and it was okay. So you can see how even in this time of technology, we can get into these situations. Always try to take a step back and know what type of market you're in. We'll talk about what type of market we're in later on in today's video. Let's break down what is going on in the sentiment. So we correctly together predicted the idea that basically we would see bears pretty much return back to above 30%. And I'm thinking this week, and I think we all think this together, is that the bulls are going to drop off a little bit considering the current price action. Remember, these reports are taken as of Tuesday, and I think we're going to see neutrality come through. Now, that's actually what we want. We want higher neutrality, higher bears, and less bulls, especially if you're looking to buy the dip. Now, of course, if you want to see sell it all and the whole thing blows up, then you want to see way more bulls, way more neutrality, and a lot less bears, because of course that leads into that situation. There's more to it than just sentiment reports. Of course, it comes back down to the options market a lot of the time, but that is something that we're looking at, and we will have that report Thursday, Friday this week on the show. Let's break down something else that I see going around the internet a little bit. We're always comparing at the moment to the dot-com bubble. And this is an interesting one here, which is, of course, the Netscape or the browser bubble versus ChatGPT, which can often be seen as the beginning of this AI run that we've currently seen. Now, funnily enough, if you track them together, they look ridiculously close. Netscape versus ChatGPT in terms of the NASDAQ change over that 2-year period actually tends to accelerate in this back last kind of quarter. And I think that's pretty interesting because when you actually break it down, this is only where we're at right now. Now, I don't think we're ever going anywhere near this. So firstly, I'm going to disregard this chart, and I think we all should. This is a bit ridiculous. To see that type of percentage return coming out of the NASDAQ is actually very unlikely. And why is that? Well, it's got to do with market cap. Let's be real. How many trillions of dollars would it have to be worth at this point? It's not possible. It's ridiculous. So no one can believe this chart itself. But what I do think is interesting here is that we're following a trajectory which may lead into something more like this, and then that's where the end is. So we could still get a little bit bigger before things blow up. And remember, we are looking for certain signs together. This is what we're looking for. We're looking for signs that the economy is collapsing or the economy is weakening underneath the hood that is actually giving us edge. Now, a lot of people are talking about the rate cut coming forward, and some people are starting to break it down like this. They're saying, well, look, there's this expectation that the market believes there's going to be rate cuts, but of course, we may not actually be getting them. Now, this is what Deutsche Bank and a few others believe. You can see here, they think that this is actually a false move, that we're not going to necessarily get these types of cuts. I'm not too sure. We've seen it before, of course, last year. Generally speaking, we don't tend to cut into inflation until something is very bad in the economy, and maybe that's what's going on. I've always said the same thing. The Federal Reserve doesn't usually cut out of the goodness of their heart. They usually do it because something is broken and they know it. And while we all believe there's something broken probably in the back end, I think this is also a political thing. So you've got to remember the Federal Reserve for the first time ever is being kind of weaponized in some way to do these cuts. And this is all across the Western democracies of the world, including Australia. It seems to be like we make knee-jerk reactions which are not good for the long term, but instead good for short-term gains or short-term happiness. And in this case, that's what's going on. Of course, it's leading to the Russell 2000 also performing the way that Wall Street has kind of projected it out, finding that breadth in the markets. So what about the percentage of industries with actual job gains? Because of course, jobs are what is really been driving such amazing gains in the markets. Well, only 65% of industries have gained jobs in the past year, closing in on levels associated with recession. Now, this basically means that the Fed, or their higher interest rate job, is kind of doing what you would expect, weakening the jobs market, which is what they were trying to do, lessening the pressure on services potentially, and bringing it more back down to earth. This is a very unique time in history, but again, there are different ways to look at this data, and I think that this alone is not going to show us a recession or something else is coming. So just remember, we'll bring more of these data points up as we break it down, but we are looking for that edge, that sign. And at the moment, one of the best signs to look for is uninverted yield curve. And then our belief is somewhere between 3 to 6 months after that uninversion, we're probably going to start having problems. Let's have a look at the S&P 500 underneath the hood though. What's doing well and what isn't? Mega caps are down, but guess what? Small caps are up. Percentage of S&P 600 stocks with 50-day over the 200-day is starting to increase. And we're seeing that real rotation on a chart like this. Now, is that a bad thing? I would say it's not necessarily terrible. We've had this quite a few times before where we've ended up having like a little double dip here back in 2019 where small caps started to do quite a lot better. But it is an interesting point. Another one that could be looked at is something back here in 2017-18 where small caps started to improve. And this was a sideways period in the market. And then we ended up going on actually quite a nice run after that. So I don't think necessarily this chart is scary. I think that at the moment with so many of these small cap stocks doing okay, that's a good sign. New highs also starting to improve. 571 versus new lows 59 in the S&P 1500 from Grant Hawkridge over on X. You can see here the 10 and 21 day reads are very, very good. And this is pointing towards, of course, continued strength in those markets. Now, this might be a little bit hard to see over here on the YouTube video, but basically it's a lot of sectors that are doing well. Coal is doing really poorly. Another one that's doing really bad is consumer electronics. Semiconductors, of course, weakened recently, which we thought. But across the board, it's mostly green in some of the smaller sectors. And that's a good sign. And it leads us to believe that we could be following this same path. And that's the Russell 2000 performance 12 months after key market lows. Look how well we're following the average right now. And we just started to play catch up. Now, interestingly, the catch up ones, so you can see here, here's a catch up one, here's a catch up one, here's a catch up one. They actually, one of them goes ballistic after it. One of them actually goes sideways for quite some time. And the other one kind of goes sideways into up. So when we're doing this catch up period, which seems to be part of maybe just only 3 of these particular squiggly lines, it does kind of tell us that yes, there's more to come. Yes, there's probably a decent percentage. It might even beat the rest of the market. It's possible, but it's not going to be like absolutely ballistic, you would think. And that's I think a key point here. It's going to be a good, solid, hopeful gain. We actually asked everyone in our live streams that we do on Monday for free. And of course, we do have private live streams Tuesday, Wednesday, Thursday, etc. You can find them in the links in the description down below or the comment section. But basically, we were talking about it, and most of you were thinking about 250 on IWM is where your year-end target was. 250, 260. Fundstrat's Tom Lee believes it's 300. I thought I'd put a couple of extra charts in here before we talk about the dark pool liquidity. This is an interesting one. I do often look at the housing market to see whether it's really struggling. And this is median days on market in the metro areas. Now, I find this a very interesting chart because, of course, the hottest market at one point was down here and down here. That seems to have ended and people are going to other areas. In particular, over here seems to be doing very well in the US. So you can see here the median days on market getting into those 80s down here and kind of the Florida area. And that is, definitely showing a sign of slowing in that area anyway. But across the board, I would say it's still a fairly healthy overall property market. Of course, yes, ridiculous prices, but this is all part of the Ponzi scheme. This is what we end up getting into. Let's have a look here at the Chinese market. Now, of course, a lot of you probably not very happy with the Chinese market at the moment. It's been severely underperforming. This is a very interesting way of looking at it. And of course, this is what you should do, long, short style analysis. So this is the Hong Kong market versus the world kind of market here. And you can see it's been performing well at one point. We saw that massive outperformance. And then now it's been weakening for quite a long period. Now, this is an interesting point because, of course, we're starting to see not so much maybe a baselining effect. And we'll look at this on the charts. The most important stock, in my opinion, in China is going to be something like Tencent, which we'll look at later on. And that's the one we're actually looking for seeing some strength into. Let's go back to the US for a moment, though, before we talk about earnings and these big dark pools. The Whaley Breadth Thrust. I never discount this one. This plus the 7070 Breadth Thrust are very good reads if you're an investor, swing trader, multi-month trader. any of those types of things. Now, again, we expected weakness over the next 10 days and we got it. The next kind of period here, though, things should theoretically start to improve. Remember, this does have a 252-day, 100% track record with insane median returns. And they are insane. When you're looking at double digits, remember, for anyone that's been trading here, we've got people in this community, you guys have been, some of you have been trading 30 years plus, 40 years. I've been doing it, 17 or something. So realistically, we are going to points here that not only can we track back quite a long time, but it's not normal to get these types of returns. Remember, this is symptomatic of a hyper bubble. And that's one point. But overall, the Whaley breadth thrust is very strong. And every time we've seen it, we've tended to do quite well in the markets. And we need to keep that in the back of our mind if things start to turn technically bullish. Now, do we still see a lot of volatility in the markets? Yes. Why? Well, the VIX is telling us so. It says until we get to the election, we should see increased volatility. Now, we are looking for a VIX 20 plus to really show us that we might have found a bottoming on the market, and we'll talk about that soon. But let's go over to earnings. S&P 500 growth, guys. It seems to be coming from a lot of companies that are earning money overseas and making a decent amount of their money over that period. And we know that this week is huge. Tuesday after the close, the next trading session at this time of recording, we've got Microsoft, AMD, Starbucks. Now, we will be doing a special on each one of these after the event. What I tend to do is I always look at the markets after they've done it. I always have the patience to react to the market unless I'm selling premium. And the main reason is because you usually get better trades there. Otherwise, it's a bit gambly going into it unless you're investing in them long term. Then we've got Meta, then we've got Apple, we've got Amazon. This is the biggest week. Nothing is bigger than this week when it comes to earnings. It's huge. And remember, the expectations of overall options market moves are wild. AMD, Starbucks, Microsoft, Meta is expected to move between 9 and 10% based on the options market, and ARM is expected to be plus minus 12. This is going to be hundreds of billions of dollars flying around in the markets with wild moves. I mean, we've never seen such huge moves across big tech during earnings season. It's just getting into those points where, in many ways, there are great opportunities because the volatility is so extreme, even though it may not look so on the indices themselves. Earnings estimates are still looking pretty good, even though we may not believe them. That's really what is happening here. And you can see here where the expectation of growth is. And you can also see here that we still have the possibility of getting higher. Yes, we could go more ridiculous, such as when we were in 2021. And if we actually took this chart all the way back to 2020, it was even more ridiculous. So again, Jurien Trimmer, some great charts there. Speaking of Jurien, we do also have this one, which is, of course, us following the hyper bubble periods. And we tend to see a lot of return in these. We tend also to see further runs. We're looking at a base case of around 900 to 1,000 days of run over this bubble. And that puts us into back end of 2025. And I will release some of my kind of expectations for that market moving forward as well, because I think it's going to be a very interesting time. And there could be some pretty big gains on the market if everything plays out the way it has. Of course, if things change, we'll be all there together looking at those. Specifically, the bonds market will be what we're watching. Speaking of dark pools, though, let's have a look. So we know that semiconductors started to get a little bit of hits last week. We know that people were selling it. There's no doubt that Wall Street was on the sell-off train. Now we've moved into basically a bear market almost in terms of technicals with 20% sell-offs on some of these things. But we're starting to see buying. Well, we can assume it's buying because there's large trades coming through on semiconductors. There's some interesting trades coming through on the Qs as well at these levels. And then there's some interesting trades even coming in on the Bitcoin markets and Ethereum markets. And again, we're starting to see it even in SOXL. So we're seeing it in ETFs for the semiconductors themselves. Now, this is all, fairly large trading. Remember, Wall Street or larger players, they don't really have stop losses. They just have positioning. So the market can easily drop underneath this level and they may still continue to buy more. And it's actually when it gets back above this level that the momentum starts to shoot into the markets. So really, if it drops further and then it boosts forward, that's going to be an excellent sign that really the bottom's in on the market. And we are looking for those signs. And of course, we'll update everybody here. We're all going to be doing it together to find those reasons. Let's have a look at rotation. Well, we know that XLY had the best session, a little bit of defensives, ITB still out there. I'm looking at 5-day and year-to-date rotation mostly here. And again, it's the big banks, the small banks, and the home builders that are out in front. That is not symptomatic of an incredibly negative market. It is symptomatic of a deregulating market that is filled with debt and is basically starting to expand on bad pretenses, sure, but at the same time, it is expanding on debt. Let's have a look at the S&P now and break down the key levels that we need to be watching. So it's pretty clear that we've got that problem at 54.90 to 55.10. We mentioned that on the Monday session. It seemed to be a bit strong for the market, and the market ended up selling off a little bit. Now, we did find this super negative looking candle last week, which we felt would bounce, and it did, but we know this is a very important level. And if we get past here, where do we go to? Well, I think it's pretty clear that 55.50 will be the next target. Why? It's the gap fill. So effectively, that's the area that we're expecting, if we do see a rally, the next bears to be sitting at. Now, I've done this onto the futures market so we can have a look at it together, and you'll see the one-day expected options moves. You'll see the major put zone, which is 54.30 over the next trading session, which is Tuesday. A lot of puts sitting there. And we know that the market pretty much wants to find buyers here. If it doesn't find buyers here and it keeps dripping lower, next stop's 53.50 and 5300. Now, 5300 is our case scenario for where we think real buyers, really big buyers would come in, because it's also the weekly 20 moving average. We know that to be mean reversion. It's one of our favorites. We've used it several times together over the last coming years, and basically it's been pretty damn solid. So what about the bulls? Well, again, the bulls need to push the 54.90 to 55.10 level. If they can do that, then they'll move it, I believe, to the gap fill, which is where all of this started with the Google Tesla earnings. And of course, if we get above 55.90, which is a key strike as well moving forward, we're more than likely going to go hit a new high. So things are looking, you would almost say neutral at this point. Of course, I'm kind of going a little bit more into the smaller timeframes and having a look around. You can't really make a super case for the bulls. I did think it was oversold here because we saw that on semiconductors. We know there's large transactions coming in. At this point, things turn, of course, a lot more bullish. But yeah, these are really the main problem lines. And if the market cannot find bid around this zone, because this is the key point for bids, then of course stop losses will be generally under there. Then yeah, it could keep to bleeding through till the 53.50, 5300. But let's have a look at the options, whether they agree with that. And it's in negative gamma. So basically the markets are overall, if we start to fall through some of these zones, you can see how many puts are stacked over the next 24 hours. I think a lot of these puts are stacked coming into earnings, bit of hedging going on, but you'll notice they're also there for the 31st of July. 54.30, 54.40 continues to come up as a massive strike level over the next two sessions. If we cannot hold that zone, and you'll notice that we're just above that, including spot 54.60, then we probably are going to start to create a cascade effect down. This is where the buyers have to sit. They are basically put walls. And we know that when we've looked at this in the past and we've seen positive gamma and negative gamma situations, when negative gamma or positive gamma cracks a zone, it tends to create a cascade effect. And you'll notice when you really look further forward and you start looking at the OPEXs in September and August, that you start to push a lot of 5300 narratives. So that's why we get that 5300 so much. We get a lot of puts being struck on the biggest strike level zones at 5300. What about the CTAs? Have they started buying? Answer for S&P, no. NASDAQ, no. We haven't really seen significant buying. Brent, weak. We'll look at that in the charts. Gold, weak from the CTAs. We'll look at that on the charts. Silver, weak. We'll look at that. And you get a kind of common thing here. All of these metals, all of these commodities are actually weak on CTAs. But some of them, like copper, 10 of the last 11 sessions have been selling off. That is an incredibly high sell-off rate. Let's have a look at NVDA in terms of the overall strike zones. Yes, we know that NVIDIA is coming down to a very important level, around the 110. We've often said 110 to 122 or 120 is pretty much where we expect NVIDIA to find buying pressure down here and find selling pressure up here. And it continues to remain in that level. Let's go over to Tesla for now. Tesla is trading at 232. Now, if it's able to get through 235, this week expiration, you'll notice here is super struck at that level. So that's where the res is at the moment at 235. We have possibilities of island reversals. This zone here, if we get through, we start to move forward in price action, that's going to be a positive gamma situation. And Tesla is moving into positive gamma after being quite negative. VIX, let's start off here with the leads. VIX, not above 20 yet. Theoretically, we usually hit above 20 to see a low in markets, so I would expect volatility to come back in at some point. XHB, still really good, so home builders is good. Regional banks are good. And my bond indicator here, the one that we use to see whether there's significant risk in the markets, is starting to weaken. There's no doubt. So if that starts to weaken further, that is a bit of a warning sign that we're probably going to see a new low. So we'll be watching that. High yield junk, on the other hand, still very strong. So that's good. Copper. Now, last 10 of 11 sessions all down. Significantly oversold, almost egregiously oversold now. But that doesn't mean that you just go out and buy the ship and say, yeah, fantastic, let's buy copper. If you were to say, okay, I want to start scaling in, of course, you'd need stops underneath this 4 level over here on the left-hand side. And we're looking at a 420 plus breach to really show us strength. My current scenario is I'd like to see copper weaken again, then strengthen, get through 420. And I think at that point, you've got a interesting technical trade in the hands. US dollar ends up finding strength after looking like it could weaken, started chopping around in here. Strengthening up, maybe it gets into the supply. We'll watch the US dollar. This week is non-farms, so we know that usually it'll work. It'll pretty much sit around and then go wild on Friday. Let's go over to gold. Gold also waiting for non-farms. Beautiful buy area at 23.50 and 23.25. So both areas are good. Bull swing zone at 24.30. That is significant for gold. That'll be a huge level if it can get through. Silver, on the other hand, significant bull level at 29.40. And right now, I don't really know what silver is trying to do. It's oversold. It didn't come down to my first 2 levels. This was a great short if you did end up getting that. Fantastic for you. But yeah, I would have expected it to go to 27.20-ish zone. It didn't quite get there. So if we go to smaller time frames, is it starting to show some strength? I would say not really. You could mark out here if you were trying to get to a day trade, just looking for kind of like a higher high. That would certainly be key. US oil, so important that it starts to find barrel trade buys. It is just weakening and weakening and weakening. We have not had a significant trigger yet to buy oil back in since we broke through the $80 a barrel. So obviously we're looking for a turn, but we have not seen that yet. What about energy stocks? They're holding up pretty well. Still bullish on energy stocks. Still looking for these to obviously turn around towards the bull side. Not too much to update there. We'll keep going through it. Now let's move it to HSI. It's had some good and some bad sessions. It finally found a green on the Monday session here, and then it's weakened off here in the futures in the Asian session. So basically, we are seeing weakness across the board in China. We're seeing some support coming in from the government. We're at a 75 fib. We're at oversold parameters, but we do not have a trigger buy yet. So yes, we're waiting for that. And really, as I've said several times, this is not necessarily a trade unless you are using very specific timeframes and you're looking for certain things. It's more of a position base because you're trying to pick basically the end of a great sell-off on the Chinese markets. This is the chart that I'd be looking at though, 10 cent. Now you can see here it's kind of floating around. If that gaps up, gives us an island reversal, that could be a really great sign. I'm looking for a 377 to really trigger in what I would say is a buying area. UK 100, very strong in my opinion. Failed though to create a green above 8,300, which is a little bit weak. But I think overall pullbacks to be met by bull demand here on the UK 100. A very interesting and good setup when you consider all of the situations. So is this showing, look at that volume increasing too. When you're looking at this, is this showing that we've got further runs on commodities and energy coming forward? Well, certainly the UK 100 started blitzing the other day. NVDA, many red days, nothing holding a green yet. Needed above 116.60 to get the 122, which we know is the gap fill / the options call level. So you'll see that quite a lot at the moment, and a daily 20. So my kind of base case at the moment is I'd like to see like a rally and then maybe see a drop and then do that. That would be fantastic. That would be probably the best expectation we have here. Bit of a rally, go down, get a VIX 20, makes a lot of sense. Tesla, on the other hand, did it island reversal. Morgan Stanley upgraded it off forward, certainly looking a little bit better. And you can see here that we have a market that's starting to turn around and improve. So certainly something that is looking decent. If you're going to trade this type of thing, an island reversal by itself is not a key level. It's not going to give you as much edge, but generally you'd place a stop loss below the low and hope that those options come through. 235 in particular, you'd want to see closed above. US 2000, just consolidating. There's nothing wrong with that. We're absolutely looking at a decent consolidation zone, and we know that this is, of course, that key resistance. So we're looking for this to be breached above 2282, should bring us 2430. So we're looking for that. Still a series of higher highs. Not really too concerned about the US 2K. Let's move over to the NASDAQ. Like the S&P, it's hit that key zone. It's hit a level that we're looking for buying pressure. We have not seen a higher high, so it didn't trigger in the buyers. The better trade would have been this, and that to the gap fill up here would have been the best trade out there in the market. So it's still theoretically weak. The bears are still in control, and the gap fill area here would be around 19,744. So something to watch up here, anywhere in here really, is where you're going to be seeing the bears recommence if we do end up getting a rally. Also look for things like this 2-hour 20 being closed above, something like that. Bitcoin coming back down to a key level. Want to see 65.6 being held. Of course, some Trump comments about SEC stuff ended up pushing this up, but this is good. To sit here and consolidate about 80% of the move on the way back up before this, if this coils here and then blitzes out after coiling, is going to go ballistic. So this is a not so bad position. We want it to hold this zone though, must hold. Bitcoin needs to hold this area. That's going to be really important. For the week ahead, guys, we have a little bit of information coming out, of course, well, quite a lot. We've got things to do with the US, which is of course to do with the overall rate statement and the press conference. That'll be interesting to see what ends up going on there. That'll be a little bit volatile on Wednesday. And then, of course, on Friday, we also have non-farm payroll. So it's a big week of news, but it is earnings season mostly kicking off. All right. Well, if you enjoyed today's video, why not check us out on some of the other things? Thank you so much for watching. Follow us on X. Check out some of our overall courses if you want to know how to replicate some of these strategies and setups. And, of course, understand cyclical events a little bit more, which is such an important concept to your investing journey and actually just understanding the economies as a whole. Thanks, guys. We'll see you next one. Bye for now.